you've ever heard someone say, "We were pre-approved, everything looked great, and then the deal fell apart," you're not alone. It happens far more often than it should, and usually for reasons no one explains up front. In this video, we're going to talk about why a mortgage can still fall apart after pre-approval, what actually changes between pre-approval and closing, and what you can do to protect yourself. This video isn't meant to scare you, but it is meant to make sure that you're informed. A pre-approval is an initial financial review, not a final approval. At pre-approval, we are looking at your income, your assets, your credit, and your debts. We're determining whether, based on the information provided and documented, you qualify for a certain loan amount. What we don't have yet is a property, an appraisal, title work, HOA documentation, and final underwriting conditions. That's why pre-approval is a strong starting point, but not always a guarantee. The biggest reason deals fall apart is change. Mortgage approvals are based on a snapshot in time. If anything materially changes, the loan needs to be reevaluated. Common examples are changing jobs, switching from salary to a variable income type such as commission, a reduction in hours, taking unpaid leave, opening a new credit card, buying a car, co-signing for someone, or large unexplained deposits. Even changes that feel harmless can trigger underwriting issues. Changing jobs mid-transaction is one of the most common problems. Even if you're making more money, you're staying in the same industry, and the new job just feels better, it can still cause issues. Why? Because lenders care about income stability, pay structure, history, and predictability. Switching from salary to commission, bonus, or self-employment, even temporarily, can delay or even derail a loan entirely. Always talk to your lender before making any employment changes. Opening or using credit during the underwriting process is another major risk. This includes new credit cards, auto loans, financing furniture, buy now, pay later plans, co-signing for someone else. Even a small new car payment can increase your debt to income ratio, lower your credit score, change your loan pricing, or push you over program limits. This is why lenders are so adamant about not touching your credit until after closing. Another surprise for borrowers is how strict lenders are with banking activity. Large deposits usually must be documented, sourced, and explained. Common problem deposits include cash deposits, transfers from friends or family, sale of personal property, crypto transactions, or moving money between accounts without documentation. If money can't be clearly sourced, it may not be allowed, even if it's yours. Even if you qualify perfectly, the property itself can cause problems. Here are a few examples. The appraised value comes in lower than the purchase price. The condo HOA doesn't meet guidelines. There are title issues. The property has condition problems, or insurance issues such as inadequate coverage. The borrower didn't change, but the risk profile did. A pre-approval is done by a loan officer, but the final approval comes from an underwriter. Underwriters follow agency and investor rules and guidelines, interpret risk conservatively, and may ask questions that loan officers did not anticipate. This is why we as loan officers may ask for extra documentation up front in anticipation of what underwriting may request. These requests sometimes feel redundant or excessive, but underwriters are protecting the lender and the loan's eligibility in the secondary market. This is why it's crucial to work with a lending team that's experienced, knows what underwriting may want to review based on your specifics. Another issue is when things are reviewed, if documents are rushed, if a pre-approval is issued without full review, and complex income isn't analyzed up front. Problems may not surface until late in the process, when timelines are tight and stress is high. Most mortgage horror stories aren't caused by bad borrowers, they're caused by work not being done early. Here's what you can do to dramatically reduce risk. Get fully reviewed up front. Not just a quick pre-qual, but an actual document review. Don't change anything financially. No job changes, no new credit, no large deposits. Communicate. If you're unsure, ask first. Understand the property types. Condos, multi-units, and HOAs might need some extra vetting. Work with an experienced lender, one who explains why, not just the what. Pre-approval is a critical step, but it's not the finish line. The smoother transactions are the ones where expectations are set early, risks are identified up front, Borrowers understand the process and nothing changes unexpectedly. Most loan failures are preventable with education, planning, and transparency. If you found this video helpful, make sure to subscribe and follow us for more straightforward mortgage education. And if you're early in the process, start asking questions now. It makes all the difference.